Welcome, welcome, everybody.
Come on in. We're talking all things Parent Plus loans.
Welcome. We'll give some folks some time to get into the room. We're a minute early, but we'll get started pretty promptly. But we look forward to this. Thank you guys for joining in. I know it's the holiday week, so I know you're probably busy, maybe at your grandparents already or at your parents. So we'll make sure to cram a lot of good information into this 1 hour session.
As an FYI, see, we're already at 68 people and we're at 4 o'clock on the dot or 5 o'clock on the dot, or maybe 3 o'clock on the dot, depending on what time zone you're in. But we are expecting 460 people for this webinar this evening. So like I said, bear with us for a few moments as people kind of find their way, they click the buttons, they do all the things they need to do. Like I said, we're not going to hang on too long. We know you all's time is valuable, but we are going to give it a few minutes, just 1 or 2 for people to come on in.
Yep. And just some housekeeping things. We have the Q&A section of Zoom open. So you will be able to put questions in the Q&A section. Maybe hold questions until we get started, because I know we're going to go through some basic stuff first. Then we'll get into some conversations about the double consolidation. So if you have specific questions as we continue to work through some of the material we'll go through today, we'll try to get to as many questions as possible. So that is there for you to use. The chat feature is closed. We will be able to send information in the chat, but y'all can utilize the Q&A section. And I'm also going to just drop in the chat now. So of course, we are both with Student Loan Planner, and we do one-on-one consultations for student loan repayment in general, but we do, of course, help folks with Parent Plus loans and the double consolidation specifically. So if throughout this conversation you're feeling overwhelmed, or you're feeling like your situation is a little more complicated, or you just want that extra help, then we can schedule a one-on-one consultation, and you could work with one of us on the team to walk through and put together your specific plan. So I put that link in the chat in case anyone wanted to go do that after our call today. And yes, this will be recorded. We're gonna, I believe, repost this to YouTube, so you'll have access to it on YouTube as well. We will be doing some screen sharing during this conversation, so it might be good to have access to a computer right now, or your phone, to where you can view what we're going to be covering. Not completely necessary, but I think that could help with the experience.
Yeah, so if you're driving, get home safely. We don't want you looking at the screen while listening. You know, he said a lot of it will be you can take it in audibly, but it would be nice if you can take a look. So we've hit 4:02. You think you want to get started, Megan? Yeah.
Yeah, I think we get started.
Yeah, we're at 1:07. I think people will kind of continue to trickle in. We want to be mindful of those who showed up on time, ready to rock and roll. So my name is Lauren Williams. I am a consultant at Student Loan Planner. I joined the team as a second hire in 2018, and I have loved this work. So my very long story short is that I run a financial planning company, and the first person that came to me that was not a family member or someone that I knew directly had $360,000 of student loan debt and made about $140,000 of income, single individual living in a small town, a cheap cost of living. And I realized almost immediately that all the certified financial planning coursework, master's degree in business, yada, yada, yada. I've got, degrees and certifications out the wazoo. I had no idea how to help the young lady. And I was like, gosh, she makes a really good living. She lives in a small cost of living place. And she has student loan debt that is literally double her income, a really nice house, you might as well call it, and you can't live in it. And I had to go down a rabbit hole to figure out how to be able to help her, and kind of became obsessed with student loans ever since. Bumped into Travis shortly after, about a year later, And he saw that I had the same kind of passion and love for student loan planning as him. And now I've been a part of the team for, I think it's now 4 years. And I'm joined today by Megan, who I'll let introduce herself, and then we'll get this party started.
Nice. Yeah. So I'm Megan McGuire, formerly Megan Landris. I have my own financial coaching practice. So I work with folks really close to right after school or within the first couple of years of their career to get the basics of their financial plan in order. I became obsessed with student loan planning. My first client, one of my very first clients, my own financial coaching practice was a chiropractor who had about 300,000 of student loan debt. Similar to Lauren's story, I was very overwhelmed because I was, setting out to help people, and I knew student loans would be part of the equation, but I didn't realize that student loans could be in the six-figure range like that. And with her income situation, it was something where it was just not going to be an option for her to pay it back like a normal debt. So I did a lot of research, learned the student loan system is complicated, and that is a good and bad thing. Good thing is that there's a lot of repayment options available because of those complications. There's a lot of ways that we can really put together and craft a plan that can help have an efficient plan, but also help within the budget, help with the rest of your finances. So I got really, really into it because of how impactful I think student loan planning can be. But it starts out as this big elephant in the room. So we're going to talk about the big elephant of Parent Plus loans in the room today, because Parent Plus loans it's not new. Parent Plus loans have been around for a while, but they are a growing problem, I should say, because the cost of attendance is getting more and more expensive, including, undergraduate degrees. And so Parent Plus loans are a way that you can borrow for your child's education. So we're going to get into some of the basics about Parent Plus loans to start. We'll talk about some options for when we go into repayment, and we're going to go through some case studies today. We'll talk about the double consolidation loophole, what that is, how it can help people, and really get into some of the nitty-gritty details. So just a quick recap of housekeeping. There is the Q&A section that you can submit questions to throughout this conversation. I think we'll go through a lot in the beginning that can maybe answer some of the basic questions, but if you have more specific questions catered to your situation or a family member situation specifically, we could try to get to as many as possible today. And then in the chat, I have our scheduling link for if you needed or wanted to do a one-on-one consultation with us. But I'll turn it over to you, Lauren, and we could jump into maybe the basics to start.
Yeah, absolutely. That was perfect. And I'll be monitoring the Q&A while Megan's talking. Megan and, we'll be going back and forth, vice versa. So bear with us. Like I said, we're expecting more people to continue to jump on. We're already at 1:30. So we hope to answer most of your questions so that you don't have to make a bombshell over in the Q&A area. So the first thing is, what are Parent Plus loans? These are loans that you borrowed on behalf of your children, if you are the parent, for their undergraduate degree, specifically for their undergraduate education. You may be a child of a person who borrowed on your behalf on this webinar. So your parents took Parent Plus loans. They are in your parents' name. And so that's one important piece of the puzzle that a lot of people are confused about. They're like, well, how do I, pass these over to the other person? Or how do I take control of them? I don't have a login. The loans are the responsibility of the parent. The child has no legal obligation to pay these loans. Now, of course, with family, you may be working out something different. You may be setting different expectations and things like that. So it's important to, decide what is going to be best for you. And Megan and I are going to give you a lot of options there. Because they are federal loans, if you were to pass away, the parent, the loans would pass away with you. And in the same vein, because you borrowed on behalf of a child under the federal system, if that child was to pass away, the loans would pass away with you. I know that sounds a little bit of a grim thing to jump into, but one of the things that people are usually pretty concerned about is, oh my goodness, I'm going to, pass this on to my spouse, or my kids are going to be paying this off forever, or, the other kids are going to be affected by it, and on and on and on. when federal loans are, when someone passes away with federal loans, the federal loans pass away with them. So that's one thing that gives a little bit of solace, that this won't be just dragging on forever and ever once you create a plan that is appropriate for your family. So that's the basis of it. It's for undergraduate loans. There's not a limit on the amount that you're going to be able to take. So we also have seen, quite a few people. I've seen someone already in the Q&A say that they had 181,000. It's not uncommon for us to see $300,000 or $400,000 of Parent Plus loan because you have multiple children. We will be talking a little bit more at the end about whether or not to decide to apply for them. If you are a parent that's on here who has kids that are getting ready to go to school and you're trying to figure out how you're going to pay for that, we will cover that. But we want to start by talking a little bit more about those who have Parent Plus loans, when the payments are going to kick in, who pays when they kick in, when do payments begin, the types of repayment plans. And Megan, like I said, is going to go through some different examples. So without further ado, I think we can just go ahead and jump in, Megan. I'll hand it off to you and I'll start looking at the chat and see what's going on over here.
Yeah. Do you want to jump into the case study now, or do you want to jump into repayment options first? Sorry, I was answering some questions.
Yeah. Why don't we jump into repayment options as
okay.
the first thing? Like maybe talk about like what happens if you just finished, your child has just finished school, what's going to happen, and then when do payments begin, and then maybe payment options.
Mm-hmm. Perfect. Yeah, we can do that. So while your child is in school, you do have the option to defer payments on your Parent Plus loans. Sometimes it's automatic, other times you might have to request it. That is an option. You could also choose to pay interest while your kids are in school. Interest does accrue the moment you borrow on Parent Plus loans. So the answer to if you should be paying interest while your kids are in school is it depends. It depends on the plan. So we'll talk through some ways to think about your plan here in a moment. But payments do typically begin about 6 months after your child graduates from school. And a lot of times people will have multiple children who are borrowing Parent Plus loans for. So it could be possible for you to have multiple start dates for repayment over time, depending on when your kids are graduating. So that does add a layer of maybe complexity to the case, to your situation, just because you'll have a couple different payment schedules, maybe different not repayment options, but just it will affect your timeline when it comes to if you're looking at loan forgiveness or how much your monthly payment is going to be. Now let's talk about just in general repayment options with Parent Plus loans. So you have a few different amortized options when it comes to repayment. And those, that just means that it takes your balance, spreads your payments out over a specific period of time, either 10, 15, 20, 25, or 30 years. Those are some examples of timelines that you could either choose to be within or your loan balance would dictate that you're within. And those are designed to pay the entire balance off during that time frame. And they have a fixed repayment schedule where the payment is set and that's what it is until the whole loan is paid off. It's the same payment going forward. Or there are graduated repayment options where the payment itself starts off really low and every 2 years that payment increases on you. That's called a graduated repayment plan. Those were meant to kind of mimic income growth over time, but it is not in fact tied to your income in any way. It is still designed to pay the loans off. But when I'm working with Parent Plus loan borrowers, in my mind, I see that kind of as a ticking time bomb, because if the payment starts out really low and you're maybe going into your retirement years over the next 10, 15, or 20 years, that payment's going to keep climbing. And if you're going into retirement and your student loan payments are super high, that's going to be potentially a problem for your retirement. So those options are there. Are they the most efficient? Maybe not. Could that be the case for everyone? There is not, and let me maybe say, there's not a cookie cutter plan for really anyone. I couldn't say, hey, pretty much everyone on this call should do this, because that's not the case, unfortunately. Fortunately, but unfortunately. Fortunately, in the sense that there is going to be a plan that can work for you. We just have to navigate through those options to figure out what that plan is and how to get there. So we talked about the amortized options. Now, with Parent Plus loans, there is also the ability to get access to income-driven repayment plans. Naturally, you only have access to one of those income-driven plans called income contingent repayment, or ICR for short. This plan is based on 20% of your discretionary income, which basically they take your adjusted gross income from your tax return. If you file taxes married jointly with a spouse, they take that joint income. If you file taxes married separately with a spouse, they take your own income. So that is a way that you could change the payment or adjust the payment to be either off of just your income or you and your spouse's income. Now, to get access to this plan, you have to consolidate. And what that means is you combine the loans within the federal system. So that's not refinancing. That is another option, but those are two totally different things. Consolidation is the only way you can get access to income contingent repayment. Now, there is the double consolidation loophole. So these options I'm talking about so far are all staying within the federal system. So the double consolidation, what is that? Well, I will start by saying the double consolidation is a loophole. It is not a plan that you can call your loan servicer up and say, hey, I want to do this. I want to get on this plan. No, it is a legal loophole in the student loan system that we can take advantage of. They can't do anything about it. It's there until they decide to close it. So that does also mean that we don't know if this will be around forever. Might have to take action on, or we should take action on sooner rather than later to lock in our eligibility for it, if you will. So the loophole, this double consolidation loophole, what it is it allows you to have access to not just income contingent repayment, but also those cheaper income driven plans that your kids have access to naturally. So pay as you earn, revised pay as you earn, income based repayment. Those three income driven plans are based on either 10% or 15% of discretionary income. A lot cheaper than 20% when we look at the math. And we're going to do some case studies to show that here in a moment. Now, the double consolidation loophole, the double consolidation is a real thing. We have to do a series of consolidations to kind of force access to these cheaper income driven plans. You are only able to do the double consolidation if you have at least two Parent Plus loans or at least two loans that are in the federal system under your name. It can't be between spouses, so it has to be just under your name. You have to have at least two loans. So that we will get into. We're going to dive into some technicalities of the double consolidation loophole here in a moment. I think it might be a little easier to illustrate some of these concepts we're talking about as I'm going through and explaining it. But I didn't want to skip over one other option you have with Parent Plus loans, and that is refinancing. So refinancing, this is where you take the loans out of the federal system to a private company. This is definitely an option. You can put the loans under your name, or you can put the loans under your child's name, or maybe the two. Maybe you're a co-signer on their refinance of these Parent Plus loans. That is the only way you can move ownership of these Parent Plus loans. You cannot move ownership within the federal system like we talked about previously, but you can if you went to refinance. But refinancing is completely leaving the federal system. So if we are to do that, we want to be confident that we don't need income-driven repayment plans. We don't need forgiveness opportunities, and we feel confident about the ability to be able to pay that loan back. Once you refinance, there are no takebacks. You cannot reverse that decision. So before you go to refinance, or as you're looking at your repayment options, you want to make sure you have the right plan for you. not what your friend is doing, not what someone on TV said that they were doing. You know, your student loan plan is completely independent of what, you know, other people are doing. It's personal. It's a personal decision on what you want to do with your loans. So that's an option. We'll talk about that. We'll show some examples here when we go through some case studies. But I will pause. Anything? Yeah, anything I can add?
Yeah, I see what you're saying about like once you're in the chat, you're like, I hear you, but I didn't hear it in its
Yeah.
entirety. Did you talk about public service loan forgiveness as it relates to Parent Plus loans? Since you're kind of talking about IDR plans, I thought that might be a good place to throw this in before you jump into double consolidation and stuff.
Yeah, no, that's a great point. And I'll talk about forgiveness in general as well before we go into the case study. So yeah, great point. So with going back to the income driven plans within the federal system, anyone, you know, can have access to these income driven plans. Definitely income contingent repayment. If you do the double consolidation correctly, then you could potentially have access to these lower income driven plans like repay and pay. Each of these income driven plans have a forgiveness threshold where you could be paying on those loans on that income driven plan for either 20 or 25 years, and whatever balance is left over after the end of that time frame is then forgiven. So forgiveness is associated with federal student loans. It is a very real thing, and it is something that we plan off of quite a bit if we have a situation where someone's balance of their student loans is a lot greater than their annual income. So you might be thinking, well, you know, why would I spend 25 years going towards forgiveness when I can just pay it off? And the answer to that is, well, if you can pay it off mathematically, if your balance is maybe less than your income, you might have the ability to pay that off pretty, I won't say easily, but pretty effectively over time. And that might be a very efficient plan for you. But if you're someone whose balance is a lot greater than their income, or you're looking at retirement in the next couple of years and your income will be a lot lower, and you're not able to manage maybe the standard repayment amount for paying the loans off, then these income driven plans and forgiveness can be a safe haven. Very real options. They do exist. They do work. So depending on the plan, you're looking at either a 20 or 25 year timeline to forgiveness. And then if you are a public servant, so Parent Plus loans do have access to public service loan forgiveness. The loans just have to be consolidated. The double consolidation could be ideal for this scenario because it keeps your payment as low as possible to pursue this program. But public servants, so that includes folks in nonprofit, 501c3, a lot of hospitals are 501c3, or government. So if you're working as a teacher or a police officer or someone in a federal, state, local, city, tribal capacity, then you can have access to public service loan forgiveness. Public service loan forgiveness will forgive your loans, the federal student loans, after 120 qualifying payments. So that's about 10 years if you are completely consecutive with your work and with your payment history. And whatever balance is left over after those 120 payments is forgiven, and it's forgiven tax-free. So it is a great option for those who are just naturally working in public service at a nonprofit or as a teacher. So great opportunity for maybe if that's applicable to you, but forgiveness is also an option for just anyone, even if you're not in public service, through those income-driven plans. So we'll talk through this case study next that can maybe highlight some ideas on what this looks like. I'll maybe throw in some average like balances and incomes that we typically see, and we could start to go through the technicalities. But I will pause. Anything else I should maybe touch on, Lauren, or anything you're seeing quite a bit of in the chat?
No, I think you're covering it. Like I said, I'm getting a lot of double consolidation questions. I have 3 loans. How do I do it? So
okay, great.
I think it's a great transition into where you're heading next anyway. So yeah, go for it.
Perfect. Okay. So I will start sharing my screen. All right, and so let's talk about the double consolidation. Now, let me maybe back up and say the double consolidation is necessary to get access to these cheaper income-driven plans. Parent Plus loans naturally only have access to income contingent repayment. That's the more expensive income-driven plan. If you've already consolidated all of your Parent Plus loans, or you just have one loan on your loan file, then the double consolidation is not an option unless you were to go and have another loan borrowed at some point in the future. You have to have at least two loans. So this is an example. So I'm using the studentaid.gov website as an example. This is the online consolidation application. This would be something that you could log in and look at yourself to see what your loan situation looks like. You don't have to go to the consolidation application section. There is a place where you can view your loans on studentaid.gov. You could just click view loans, view loan details once you log in, and it'll list your loans. So you need to have at least two loans to be able to do this double consolidation. So I'll talk through the mechanics of it, maybe giving you some visuals using these samples here. So if this person were to go and consolidate this balance, just combining these two loans together into one direct consolidation loan, they would only have access to ICR, like we've talked about, income contingent repayment. The double consolidation, what we would do in this exact scenario is we would consolidate this loan, number one, by itself, and we would consolidate this second loan by itself. They become their own direct consolidation loans. And you might be asking, well, how do you consolidate one loan? It is possible to do that with Parent Plus loans. So you would just have to consolidate them completely independently. And what you would do is send them to two different servicers. You can actually stay at your current servicer for one of the consolidation processes if you wanted to, but you would have to send the other consolidation to a totally different company. Why do we need to do that? Well, if you call up the loan servicer and say, hey, I want to consolidate these separately, they're not going to know what you're talking about. They're going to say, no, we'll consolidate them together. That, it doesn't make sense to separate them. Again, we're working with a loophole, not a repayment plan that the servicer can help you get on. So we would need to consolidate this one by itself, take this second loan totally by itself to a totally different company, consolidate those separately. And what we would end up with is two direct consolidation loans. They both only have access to income contingent repayment. Now, the key for getting access to those cheaper income-driven plans comes with that next step, the final consolidation, where we then consolidate those two direct consolidation loans together. We then end up with a consolidation loan that consolidated two consolidation loans. So see, we don't have the Parent Plus loan code in this sentence anymore. We already consolidated our Parent Plus loans on that first round. We have two direct consolidation loans as a result. So this third consolidation is consolidating two consolidations. So we don't have the Parent Plus code in the system anymore at that final stop, if that makes sense. And that is what opens up access to repay, pay, and IBR, those cheaper income-driven plans. So that is the mechanics of it, or how it works, or kind of the linguistics of how it's working. It's because that final consolidation did not consolidate Parent Plus loans. It consolidated two direct consolidation loans. So I hope that makes sense from a conceptual perspective, showing us or having an example to maybe look at as far as the loans themselves go. When it comes to executing this, I typically recommend starting this on a paper application. And let me maybe stop and say too, we do have on our website an article that I had written. We've updated it since. I wrote this a couple years ago, but I do have an updated YouTube video on exactly how to do this if you wanted to do it on your own. So don't feel panicked if you miss, some of this conversation. Also, this video is going to be posted on YouTube for your viewing later as well.
And I've already got that link in the chat as well to the website that Megan is showing you right now, the blog that she's showing you. So if you just pull that from the chat and save it, you should be good to go.
Awesome. Good stuff. So what I typically recommend is if we have, let's say 8 loans or less, then doing this process on paper to start makes sense. Mechanically, why we have to do this on paper to start is you can only do one online consolidation application every 6 months. So if we were to do that, it would take you 1.5 years to get through this process. So if we start on paper applications, which there's no limit on how many paper applications you can do, then you could start the 2 processes to start that we talked about here on this other page. We could start with these single consolidations on paper at the same time, get that done in maybe 30 to 60 days. And then we could do that final consolidation online, which will take another 30 to 60 days. So we cut our time down to like 1/3 almost. That helps us just get it done sooner rather than later. So this is the paper application for the consolidation. I'll go ahead and just drop this in the chat, but I'm gathering this from the consolidation section on the studentaid.gov website. So I'm going to drop this in the chat real quick, but this is the paper application, consolidation application. And this is what you would need to print and complete. Now, the tricky part here is you do need to have a lot of your loan data handy. And that is also why the studentaid.gov website is very important, because this is where you're going to gather your loan types. So what letter needs to be typed into that section. You'll be able to get the loan servicer details, like their address, their phone number, the balance, the interest rate. Actually, you don't need the interest rate, but the balance. And then the other important thing that you're going to need is the loan account number. Let me pull up. This is showing an example with just all ones, but this is a really long account number that you would have to put on to each application. So the loan account number is here. You could put that all in this section. The loan account numbers, unfortunately, all look almost identical. They're about a number or a letter different from each other, which is kind of annoying, but that this is what you would have to do to start this process on paper, is include this information. Now, not only do we need to include which loans that we plan on consolidating first, we also need to include the loans that we need to leave out. So this next section says, which loans do you not want to consolidate? And so we have to include the loans we do and the loans we don't on both application processes. And if I didn't say this at the beginning, I will say this now. This is a process. It is a little tedious to write this all out and to complete this. It is doable. And we do have that free video online of me walking through this, talking through it, just generally how to do it. But we do have one-on-one consultations that can help talk you through this more specifically to your situation. We have a consultation where you can book specifically with me to walk through the paperwork if you wanted that extra help. So we put this in the chat as well. There's a link to schedule a consultation if you're feeling a little overwhelmed right now, because I know this is a lot. So let's go back to that application. Okay, so you would prep this on paper to start. You would also need to include the repayment plan request document as part of this. And the reasoning for that is when you consolidate, you have to choose a repayment plan or else they'll reject the application. So I typically just suggest to apply for one of the standard plans. That way they don't ask you for income information yet, which just adds some extra paperwork that you have to submit. So I'm going to drop this in the chat as well. This is the repayment plan request. And I typically just suggest to choose the standard plan. You're not actually going to make this payment. It's kind of a placeholder until you can get to that final consolidation. So this is the second document that you would include in your mailing packet to start this double consolidation process. Okay, so we talked about some of the mechanics. We talked about where things are located, but let me go back and actually get into visually how this process works. So why this process I think is maybe worth it for folks to entertain. So I'm going to stop sharing mine and I'm going to go through some real numbers from like an average case that I typically see for Parent Plus loans. So this example, it's going to show that this is the planning software that we use, or the Excel document that we use to help folks navigate this on our consultations. So let's say this person has about 200,000 of student loan debt. They're all Parent Plus loans. We have maybe a 7.5% interest rate. That's one of the unfortunate things about Parent Plus loans is the interest rates are higher generally than what your child can borrow. Let's say this person is married, so them and their spouse, but their kids are now out of the house. We'll also entertain refinancing. So taking a look at what this would look like if we took this to a private company to reduce the interest rate and refinance. And then let's say that we're not working in public service. I'll put that we're married, filing jointly for taxes. The person that borrowed the loans makes about $75,000 per year, grows with just kind of normal inflation, maybe 2% each year, and their spouse maybe makes $50,000 a year. Same thing, normal inflation. So kind of an average case. I know those of you on this call, this is going to be across the board what your income situation looks like and what your balance situation looks like, but this might be an idea of how you could be thinking about this or looking at this. So what I noticed right off the bat is this person's balance is greater than their household income. So that tells me that this will be pretty difficult for them to pay off very aggressively. Especially if they have any other debt obligations or if they're saving for retirement. So what I look at next is this calculations page. This is going to show us what naturally you have access to with Parent Plus loans. It's not going to show us the double consolidation results yet, but let's say that this person consolidates just once, they have access to income contingent repayment. Well, in this scenario, with a $200,000 balance, household making about $125,000 together, that payment's going to be almost $1,800 a month if they're filing taxes jointly on income contingent repayment. So not ideal. That's a pretty high payment. That's a lot of cash flow per month going towards the loans, and it slightly increases over time, just assuming that this person's income slightly increases over time. So that's a pretty high payment. It is cheaper though than trying to pay it off within 10 years from a payment perspective. If we're doing the standard 10-year payment here, that would be about $2,300, almost $2,400 a month. So ICR in this case is a little bit cheaper from a monthly payment perspective. But we could also look at refinancing. We could also look at spreading the payments out over 20, 30 years within the federal system. But let's stack up maybe these more basic examples to start. So income contingent repayment, it does have a 25-year timeline to forgiveness. We don't end up getting to forgiveness. We end up paying the loans off by 2035 if we were to go that route. And that's a lot of the reason is because the payment is just quite a bit. It does pay it off within a little less than 15 years. In the scenario, refinancing might be a little bit cheaper because we are able to reduce the interest rate in this case, or in this example. We chose a 20-year term for this example because the payment would be a little bit less, but still about $1,300 a month here. So in this situation, this kind of feels like you're stuck between a rock and a hard place. There's not a lot of payment relief here if that's what we're looking for with your repayment plan. So what I would initially take a look at is, okay, well, what does it look like if we looked at filing taxes married but separately? And that sounds kind of weird because we're talking about student loans and that's taxes, but when it comes to income-driven plans, the payments will be based off of joint income if you're filing taxes married jointly. If you're filing taxes married separately, it can allow you to keep the payment off of just the borrower's income, and that can make the payment a lot less. So I'm going to switch this over to married filing separate. That'll keep the payment off of just this $75,000 per year. And that does have a big impact on the payment for ICR. So again, we're still looking at natural options without the double consolidation. So ICR's payment would be about $960 in this case, instead of what it was before if we were filing jointly, almost $1,800. So it does cut the payment almost in half. That does provide some relief payment wise. And we could take a look at what does that do long term? You know, do we end up getting to forgiveness if we just paid that minimum payment over time and we kept filing taxes separately? So in this case, the answer is yes. Between now and 2047, this person would pay about $353 towards the loans, and they'd have about $221,000 that would still be on the balance at the time of forgiveness, but all of that would be forgiven. There is a potential of taxes being owed on a forgiven balance, which I don't want this piece of the plan to scare you, because we do plug into our planning how do we save for that to prepare. But that is something that we do factor into the plan. So in this case, the income contingent repayment plan is not cheaper from a total cost perspective, like looking at it long term, but it does provide payment relief. It does provide an end to this. You wouldn't be paying forever. You'd be paying until 25 years was up, or until you passed away. And morbid, but could be true. And it might be the better option compared to paying $1,300 a month. But still, these options aren't great. We're still kind of in between a rock and a hard place here. So this is where we can then go into the effects of a double consolidation on these same numbers. But Lauren, anything you want to interject or slow me down on?
I wanted to hop in. I'm trying to decide if it's the right time with a kind of other scenario. I think I'll let you finish this one and then circle back to me. And I have a question I want to address verbally that came from the chat.
Okay, perfect. Well, good. So I'm going to stop sharing this page, and we're going to go into this next page that'll help me illustrate the effects of a double consolidation. So let's say, these options, income contingent repayment, married filing separately, that provided some relief, but not a lot, still not as much as we'd like. So I'm going to take this same example, the $200,000 of the balance, 7.5% interest rate, married couple. We'll start off with, actually, we'll do both. We'll look at filing jointly and separate. I put in the same income assumptions, but let's say this couple did the double consolidation. They opened access to those cheaper income-driven plans. There's a lot of numbers on here, but I'll hone in on what we're going to focus on. So now we have access to plans that base the payment off of 10% or 15% of discretionary income, and they all have forgiveness as well. So the two cheapest income-driven plans are Repay and Pay. These two are both based on 10% of discretionary income, but you'll see there's a payment difference. Repay is a plan that will not allow you to exclude spousal income. It's always going to include you and your spouse's income when it comes to the payment calculation. So it's a great side-by-side example too of what it would look like if you were filing jointly with Pay As You Earn, because Pay As You Earn is based on 10% as well. But this plan allows you to exclude spousal income if you're filing taxes separately. So we go from income contingent repayment filing jointly, which was $1,800 a month, down to filing separate for income contingent repayment, which was almost $1,000 a month. So those are the two options without this double consolidation for income-driven repayment. We go to if we were filing jointly or if we went on Repay, the payment being closer to $800 a month. So we're starting to wiggle our way down. And to take it that last step further, if we were looking at filing taxes separately after the double consolidation, we could wiggle that payment down, in this case, with these assumptions, down closer to $400 a month. That is a huge swing from $400 a month to what it was closer to $1,800, $1,900 a month. So this is the significance of the double consolidation when it comes to trying to find payment affordability. This could be a safe haven for people who are in that hard place where ICR doesn't really provide a lot of relief. Refinancing isn't a great option because it doesn't make the payment cheaper and it commits you to paying it off. This double consolidation could be a real big game changer. And the other big perk here is pay as you earn is a 20-year timeline to forgiveness. So it's shorter. It's 20 years instead of 25. The limitation with this plan, though, is you couldn't have had loans prior to October of 2007. That's just one of the eligibility requirements. But when we look at this, when it comes to just the total cost of loan payback overall, comparing this to any other way to pay these loans back is the cheapest way to go. And why is that? Because you might be in the mindset and have been taught in the past that paying down your debt as aggressively as possible is the only way to pay back debt. And that was at one point true. Debt is still not a good thing. You want to pay debt off. But student loans are a completely different ballgame. Parent Plus loans are under that umbrella because they're federal loans. Other debts don't have access to income-driven plans. They don't have access to forgiveness opportunities. So we can't treat student loans the same way that we treat other debt. We have to think about them a little bit differently. And when we look at the math here, if we were to treat this student loan situation like a regular debt and just pay it off as aggressively as we could, throwing $2,300, $2,400 a month towards this to pay it off in 10 years, you'd pay $284 in this situation for your total cost, compared to maybe paying closer to $265 with pay as you earn, doing that double consolidation, and also having an extreme amount of payment flexibility to help you be able to save and put money towards retirement. So I think this not only mathematically makes sense, but from a financial planning perspective, in this case scenario, it can help you achieve other financial goals like saving for retirement or putting money towards just anything else other than student loans. But I'll pause there. I'll see if this is a good entry point for one of your verbal questions, Lauren.
Yeah, so the first one came from a gentleman who says, I have 3 sons who all graduated during COVID. In total, he's taken on about $180,000 of Parent Plus loans. They each have agreed to assume payoff responsibility for half of the loans I took out for their education. So I thought this was a good one, Megan, because we get this all the time with, multiple different borrowers. It says, I'm interested in pursuing the double consolidation. As a first step, can I consolidate my Parent Plus loans into 3 separate consolidation loans where each of the 3 loans would for each of the loans I have taken out for my specific son. At the end of the first phase, the loans of each son would essentially be separate from those of their brothers. Under the loophole, as a future step, I would then be able to consolidate the 3 consolidation loans into a single loan. So I just wanted to kind of pause and talk about kind of what is right for one family may not be right for another, but also there's not necessarily a reason to complicate your situation. So in this situation, let's say that just to make the math easy, each of them has $60,000. You have 3 sons, each of them have $60,000 of debt. So it's a third from a payment standpoint. Because the payment is based on you as the borrower, if you have a $900 payment on a monthly basis based on the way Megan just mapped everything out, because each of them has a third, it could be each of them has to pay $300 a month because that's what you all agreed on as a family. Or to your point, I think you said 50% of that. So, you're going to pick up $600 or $450 of it. And then each of your kids is going to pay $150 each. That is your right. That is, whatever it is going to be best for your family. But I absolutely do not recommend doing 3 double consolidations. So if you have one son that has 4 loans, you do a double consolidation for those 4 loans. And then the next one, you're basically doing I don't know, 12 or 15 consolidations. Bad idea. Like I said, if you want them to assume financial responsibility, you know what their loan balance is now based on the number of loans that they have. You just need to do one double consolidation and then decide as a family who is going to pay what amount based on either a percentage or who has the more income or whatever it is that you all agree upon. So I just thought that would be relevant to quite a few different people, because a lot of people come and they say, well, my children are going to have some responsibility, or I want them to share the responsibility, or I have multiple kids and one makes more, one makes less, etc. Totally up to you what you decide to do. The other one, and I think you can jump in and address this, Megan, because the chat's going crazy again. A young lady asked, she has kids that are in school. Some are finished and some are in school. At what point the consolidation makes sense? If you have multiple kids, like, kind of trickling in and trickling out. So if your kids are staggered, what strategy should someone be thinking about as it pertains to doing a double consolidation?
Oh, I am so sorry. I started looking at a question and I was answering it in the chat. Can you repeat that question? I'm so sorry.
No worries. I was saying if it's staggered, if their loan payments are like, you have one that's, a freshman, one that's a senior, and you've kind of got your kids staggered overall, like when does it make sense to pursue the double consolidation was something that came up quite a few times.
That's a really great question. And what we have been recommending as a team is, since this is a loophole that could be closed in the future, it makes sense to do it as time goes on. So let's say you have one child that already graduated. Go ahead and do the double consolidation for those loans outstanding right now. And then that way, at least that balance has access to this double consolidation loophole. And then you can do a separate double consolidation for 2 years down the line when your daughter graduates, or 4 years down the line when your son graduates. That does mean you'll have multiple processes of this, but for safety, for the ability to just lock in the eligibility for this, I think that would be the safest way to go. Do you have to do that? No, but that is your risk tolerance. If you would rather just wait until every kid is graduated to do all of this, then you could certainly do that. But you could do it as you go as well. But one note just on your first live question, Lauren, too, about just having multiple kids and splitting up the payments. If all of your kids are already graduated and the arrangement is that they're taking over a percentage of the payment, or a portion of the payment, Lauren had a great point where you do know, or you can tell on your student loan file, how much each child borrowed and what their original balance was of the total balance. So I work with folks all the time where we'll list out the kids, we'll list out their loans, and we'll have a situation where, Sally has 20% of the payment in the future because she borrowed 20% of the student loan balance or the Parent Plus balance. Johnny has, 50%. And then your third child has the other percentage. So that can certainly be a way to make it fair if you're splitting payments between children by balance size. So there's a lot of ways you could do that, but it doesn't have to complicate the actual process for the double consolidation, like Lauren was saying. So I thought that was a great point, because we do see that quite a bit. I did get one question in the chat I did want to address, because we did talk about public service loan forgiveness. I was starting to type it out. I think, Lauren, you might be typing it out now, but public service loan forgiveness is definitely an option. Even after we do the double consolidation, the double consolidation can really help you get to forgiveness as efficiently as possible. Because if you're going towards loan forgiveness, PSLF or not, your goal is to pay as little as possible to maximize how much you can get forgiven. So if you're a public servant, this is something to look into. If you're someone whose balance is greater than their income, forgiveness in general is something to look into. But PSLF started in 2007, October 1st, 2007. So if you had employment history before 2007 in public service, that is not going to count. We cannot get credit for anything before the program existed. And if you have not already consolidated your loans, or you don't have an eligible loan for PSLF right now, then your credit towards PSLF would start now if you're doing this double consolidation process. I'll back up and kind of say that again. Parent Plus loans, as they are, just as the Parent Plus loan code, are not eligible for PSLF. They are eligible after consolidation. So that is a requirement to be eligible for PSLF in the future. Is you have to consolidate at least once, but the double consolidation is probably the better way to go to maximize your benefits there. So I think I answered that question live. I'm going to go ahead and go through some just questions live as well, because I think I could maybe identify some that might be common questions that we get or could be pretty broad for being applicable to a lot of folks. So one person asked, does the final consolidation have to be with a different servicer than the two original consolidations? And the answer is yes. You ideally need to utilize 3 different loan servicers. And I did pull the list of these servicers up. So let me get that and share that on the screen again. And again, the reason why we use different loan servicers for this is we're working with a loophole. And so if we send these consolidations to the same company, they're just going to consolidate them all together because they're not on the same page as you. They don't know what you're doing. So they're just going to combine everything within one loan, and that defeats the purpose of this double consolidation. But these are the active servicers currently. One thing to be careful about is a lot of them do delegate their consolidation processes to AidVantage, this company here. So you'll see like OSLA and Mohila, and Ed Financial, they all have an address for AidVantage for their processing. They have different PO boxes. They are technically going to process it and have the servicer be OSLA or Mohila or Ed Financial at the end of the day. So you can use them, but you just want to be super careful when they confirm which loans that they're consolidating, that they're doing the right ones and they're not combining them all together. I typically recommend using Nelnet, AidVantage, and Mohila, or one of the other two. I think Nelnet and AidVantage are ideal because they're the big jumbo companies out there. I've done that time and time again with these companies. And then the third can be Mohila, Ed Financial, or OSLA. If you're working in public service, you need to be careful because your loans will get pulled over to Mohila. Mohila is who's responsible for the PSLF program. So you have to be careful about the order of your applications. But that's a great question. You do need to use different companies. I'll go ahead and repeat too that, again, this is a process. It can certainly be very overwhelming, especially if this is the first time you've heard about this. But I would encourage you to check out our article about this, our YouTube video about this process, and then certainly hire the help if you need it. So we do this day in and day out. We do one-on-one consultations, not only to help you just walk through this process or identify if this is what you need to be doing, but also to just walk through what repayment plan you need to be on, what you can do to make that payment plan as efficient as possible, what to expect over time. Like, what does this look like over time for you if you were to go this route? And really just answer all of your questions when it comes to your specific student loan situation. So, you spend all this money for your kids to go to school, get a great education. It might be worth it to spend the money to get a consultation with someone who knows what they're doing for this student loan process. I'll pause. Lauren, did you want to jump in and address any common questions, or do you want me to continue to go through some of the live questions?
Well, yeah, there's one other here about a daughter that is in grad school and needs a doctorate, and should the parent continue to defer the loans? And I think this is something else that comes up, is how long should I defer for? Because you can defer does not necessarily mean that you should defer. So it's more a matter of what your personal situation is. And if you can't afford to pay for the loans right now, then kicking the can down the road a little bit longer may be good. But the actual doctorate loans that your daughter is taking on, or that your child is taking on, are not loans that are in your name. So you would probably want to create a student loan plan that is relevant to you and your personal situation. So we're not going to recommend that someone defer just because they can. It's more about like, what is your particular situation that might allow you, what might warrant you needing to defer the loans for one reason or the other, or to use forbearance for any reason. One that is popular for us is credit card debt. People come to us, they're 40, 50K in credit card debt, and they're coming for a student loan consultation. Well, credit card debt has, compounding interest. It is double-digit interest rates for the most part, and it's the thing that has the potential to bury you. So, we are all financial professionals at Student Loan Planner, and while you're coming to us for student loan planning expertise, sometimes we see a gunshot wound and we're like, hey, let's cover this first, because that's the most important thing. And a forbearance or a deferment in that case might make sense, but in general, it's going to be more about your personal situation, not your child's situation, on deciding whether or not to defer.
One question I've seen a couple times come up is about default. So what happens if I default on my Parent Plus loans? Where do they go? So going into default means that you stop making payments on your loans. They go to a default resolution company. The one that the Department of Ed uses right now is called Debt Management and Collections System. I think someone put it in the chat, so I had it right off the top of my head. This is not a good position to be in. Folks now, since we're in this payment freeze and COVID forbearance environment with federal student loans, they're not collecting on loans right now because of this environment we're in, but they will. Once payments are kicking back in, you will get those collections calls again. Unfortunately, the Department of Ed has some extreme power when it comes to getting their money back. If you're in default on a government or a federal loan, they have the ability to garnish your wages, your tax returns, and your Social Security. So this is not a loan to ignore. I think these income-driven plans can be very helpful because the payment can literally be as low as $0 a month, depending on your income. So if your income situation is not in a good place, or you make very low income, your payment can be very low with these income-driven plans, even on ICR. So I think take advantage of the income-driven options to keep your loan in good standing. If that's still something that is not helpful to you, then you may need to entertain working with a student loan attorney. But we definitely don't want to have our loans in default status or keep them there. It will not do well for you when it comes to garnishment and or your credit situation, unfortunately. Okay, let's see.
One other thing is if you are thinking about borrowing for your child, you want to take all the loans in one parent's name, and you want to be strategic about which parent that is. So generally it's going to be the lower earning parent. And if you have a parent in the household that is qualified for public service loan forgiveness, you want that parent to be the one to take on Parent Plus loans. I saw one in the chat here where both spouses have taken on Parent Plus loans, and they're trying to figure out how to do a double consolidation there. That's not going to be possible. So you can't mix two people's loans together and try to make them into one loan. Like I said, they're each going to be the responsibility of the person who took them out. But if you're ahead of this game and you're wanting to borrow, you want to be strategic about who takes the loans on.
Mm-hmm. Yep. And that's a good point when it comes to thinking about how to go about borrowing Parent Plus loans. So if you're someone sitting in on this call and you haven't started borrowing yet, but you know you need to, or you are in the midst of borrowing, if you are married and it's between you and your spouse, or you and your ex-spouse on who's going to be taking out these Parent Plus loans, think strategically about what this is going to look like post graduation, what payments are going to look like, what your repayment plan might look like after your child graduates. Always think about who might be in public service. So are you a teacher that plans on teaching for another 20 years? Then it's probably going to make sense for you to be borrowing the Parent Plus loans so you can take advantage of public service loan forgiveness after your child graduates with the Parent Plus balance. Another way to think about it is if you have maybe lower income, weirdly, you might be the spouse that wants to take advantage of borrowing the Parent Plus loans because the payment could be lower if you were looking at filing taxes separately. So there's a lot of things that you can do proactively if you haven't borrowed yet, to help make sure that the repayment path in the future is as optimal as it can be. So we do also offer pre-debt consultations if you're someone who's either about to be borrowing or thinking about borrowing or in the midst of borrowing, and you need an idea of how this is going to look and what the strategic way to go about it is now. All right. Let's see. I'm going to maybe find a couple questions and then we can wrap this up. I know we're coming up on time. My parents are both Title I teachers for 40 years and retired in the last 5 years. Since their Parent Plus loans are not consolidated yet, they don't qualify for, or they can't get credit for public service loan forgiveness. Is that right? That is correct. So if the loans are still Parent Plus loans, they're not eligible for PSLF. They have to be consolidated in some capacity. So they would not have any credit if they just have the Parent Plus loan code as it is, unfortunately. They could still maybe look at this double consolidation process if they'd want to look at more affordability with payment options. Let's see. My son graduates next May, and it was mentioned that payment starts 6 months after graduation. When should I start the double consolidation? This is a great question. Start it as soon as you can. So it's a process that takes about 3 to 4, maybe 5 months, depending on how fast these servicers are processing the consolidations. So you could start this process getting close to when their graduation is coming up. So typically 90 days after the loan has been borrowed is when you could start it. But start it as soon as possible since it does take some time. All right, I have personal loans for when I was in school and Parent Plus loans. Can I consolidate them all, or is that not allowed, not advised? Fantastic question as well. You want to be careful about what you do here because Parent Plus loans do what I call taint a loan file. And why that is if you were to simply just consolidate your loans with the Parent Plus loans by them, just like in one consolidation, your whole balance would only have access to ICR. You would lose the ability to have access to those lower income driven plans that you already have access to with your own loans. So that's what I mean by Parent Plus loans can taint the loan situation. So you might be a great candidate for the double consolidation process. It may or may not make sense to include your own loans as part of that double consolidation process. You could leave them out separately. There might be reasons to include it, but you would certainly want to probably keep them separate, but it might make sense to do that double consolidation with the Parent Plus. All right. Any other common questions that you've been seeing, Lauren?
How to book a consultation, the cost of a consultation is something. So we put the link into the chat. I know a lot of people are technically challenged. So you can send us an email at help@Student Loan Planner, and we will send you the same link that we put in the chat today. We don't take phone calls. We're not like a office that is open from 9 to 5 with a secretary. So everything is done online. You click the link. It'll show you a calendar. You can choose a time that works for you. Once you've booked the time, it'll notify us on our side. You'll be signed a consultant. That consultant will reach out to you independently. They'll ask you further information. The same way you're on Zoom today, we hold our consultation via Zoom. So all of that will happen automatically online. There's not a phone number or a particular, email address to get you set up. We don't go back and forth and say like, oh, I'm available today at 3 and you're available tomorrow at 4. It all happens electronically nowadays. So we make that pretty easy. The cost of the consultation is $595. I saw that come up a few times. I think it's well worth it to save $10,000 or $20,000 on your student loans and to have the clarity that you need. So I think those are the main things I've been seeing coming up. A lot of the others are people's personal situations that are that they're looking for help with. So unfortunately, we can't answer all of the questions and we've come up on time, but booking a consultation, I think will be well worth it. Like I said, we provide a lot of free resources. We have given the link a few times in the chat to the double consolidation if you want to do it on your own. For us, this is not about, collecting all the dollars and getting all the clients. It's about making sure that people have the information they need to make a good financial decision for themselves. So whether you want to book a consultation or you want to try it on your own, you're welcome to do either. We just want what's best for you.
Mm-hmm. Yeah. And I think it is a process. I said that multiple times during this conversation because it just is. And so I think one of the questions I saw is, does the consultation cover the whole process? Yes and no. Yes, in the sense that your consultation with us, we would review all of your options. So walking through what it would look like if you did not do the double consolidation, what it would look like if you refinanced, and then we'll of course look at the double consolidation. And then that helps us hone in on what your best path is going to be. We map that out. We see, do we need to be saving for a potential tax liability for that forgiveness? Do we need to be filing paperwork for public service loan forgiveness? So we talk about the plan as a whole, what that's going to look like over time. And then we talk about the process of how to go about doing the plan. And if the double consolidation is the plan, you'll have step-by-step guidance on how to do that on your own. In that first consultation, we do not do the document prep for you. If that is a step that you want to have, then you can schedule a second follow-up consultation that typically goes to me, where we would walk through and do your one-on-one or your specific paperwork. We'll do the paper applications together, and I would be with you each step of the way to make sure that the double consolidation got done correctly. So that is an option. That's a more hand-holding option, kind of quality control for the process option. But you will be fully equipped on how to do it in that first consultation if you did not want to move forward with the second, if that makes sense. So thank you guys all for hanging in there with us today. Parent Plus loans are a big topic. They're a complicated topic. Student loans in general do bring a big, it brings a stress ball to the conversation. Unfortunately, Parent Plus loans are not fun. Student loan debt is not fun to talk about, but I think this is a great first step in your journey to figuring out your next steps for your plan. So I'm happy that we were able to go through some good information today. I hope you're able to take a couple nuggets with you to apply to your situation. Check out our website. We have a ton of free content on our website if you had questions about anything specific. We have free calculators on our website you could check out. And then, of course, our one-on-one consultations where we could help you really navigate this and get your plan put together before payments kick back in the new year. But anything you'd like to close it out with, Lauren?
Happy holidays, everyone. If you are
Good point.
a child listening here on behalf of your parents, make sure you thank them for taking on this debt on your behalf. To all the parents that are here, thanks for being awesome parents. We know what a sacrifice it is to take on this debt to be able to pay for your kids' education in hopes of being able to give them a better future. So, like I said, while this is not the most exciting topic, figuring out how to pay the debt, we do recognize that it was for a really good cause and it was because of love for someone that you care about. So wish you all the best in the new year, and don't be afraid to book a consultation. I look forward to seeing you on my calendar. We are 10 consultants now, so you may end up on someone other than me and Megan's calendar, but we are all well equipped to help you and looking forward to it.
Awesome. Well, you guys have a lovely holiday coming up. Thanks for hanging out with us, and we will see you later on.